Hi, welcome. If you've been hearing a lot about buying the dip, that shouldn't be a surprise. Every time markets go down, there's a lot of advice that's meted out. Most of it is bad advice. But one of the constants you will hear every time the market goes down or a stock goes down, you should just buy the dip because it always comes back up, and when it does, you will make your money. Now, we'll look deeper at that buy the dip strategy, but it falls into a broader group of investment strategies that I would classify as contrarian. Contrarian in the sense that you're doing something that the rest of the market is not. You're buying when they're selling, you're selling when they're buying, making you a contrarian. Contrarian investing can take different forms, and I hope to show those different forms, and they're built on different beliefs about markets and how they correct. So I think it's worth differentiating across the different forms. At the end of this session, even if you're intellectually swayed by the arguments that you should be a contrarian, I would caution you that it may not work for you. Because to me, the biggest test in being a contrarian is whether you have the psychological makeup to pull it off. And we'll talk more about the personal makeup you need as an investor to succeed as a contrarian. So let's start by setting the table. All contrarian investing is built on buying something when it goes down, but they're structured differently depending on the form of contrarianism that you latch onto. In the first, which I call knee-jerk contrarianism, use a bludgeon. You basically buy anything that goes down on the assumption that no matter what it is, it has to go back up again. It can be on a company, it can be in a sector, it can be the entire market. So that's the first. In the second, which I call technical contrarianism, you buy beaten up stocks, but only if they meet some technical constraints. Technical in what sense? A charting pattern, a technical indicator, a volume indicator that suggests that the mood is shifting and therefore the bottom is near. In the third approach, which I call constrained contrarianism, you bring a value investing framework into contrarianism. In other words, you buy beaten up stocks, but you buy them only if they meet other requirements that you put in for a value stock. A low PE, a high dividend yield, low debt. It's the combination of a Ben Graham approach to picking stocks with picking stocks that are down. And the final approach, which I call opportunistic contrarianism, you already have a list of companies. We'll talk about how you have that list already. Of companies you always wanted to own but were not able to because the price was too high. And you use the opportunity of a market drop to be able to buy these stocks because now the price has dropped below the value. So let's start with knee-jerk contrarianism. In knee-jerk contrarianism, you basically buy any traded asset if the price is substantially down from its highs. Implicit in the strategy is that whatever goes down will always go back up. Or most always go back up. The evidence to back up knee-jerk contrarianism is both at the market level and at the stock level. So let's start by looking at the market level evidence. It's mostly pretty generic. Now, on my webpage, I maintain a data set of returns on stocks, bonds, T-bills, and other asset classes going back a really long time. And in this graph, I actually look at the annual return from investing in stocks opposed to almost any other asset class. Hands down, over the last century, stocks have beaten every other asset class by a substantial amount. And it gets even better. You can slice and dice the data. You can look at any decade going back the last 100 years, and stocks emerge as winners. You can even buy at absolute highs, and you still come out ahead if you wait long enough. So that's at the basis for some people suggesting that stocks always win in the long term, and that therefore if you have a long time horizon, you should stay invested in equities no matter what you think about stock prices and through the worst downturns. Now, there is of course a small print that you're not being told when you see those returns over long periods. Now, those returns over the long periods become even better if you can buy at low points in the market. So if you add other criteria, you say, this becomes great. You can buy stocks, hold them for the long term, you're going to be okay. Here's the small print. That graph that you saw was for the US market. You're saying, so what? The US equity market was one of the most successful markets of the 20th century. Statistics. We have this notion of selection bias. You pick the most successful equity market of the 20th century. You find that stocks always win. And then you extrapolate from that stocks will always win no matter what market you're in what time period. That's pretty dangerous, right? The second is, even in the US, there have been points in time where we invested at an absolute high. You had to wait a long time to get back to be made whole again. An investor invested the peak of the market in 1929, just ahead of the great crash, would have not made his money back or her money back till 1954. That's a pretty long time horizon. So even though stocks might win in the long term, it's a pretty poor basis for arguing for contrarian investing, but a lot of people do. At the individual company level, the strongest evidence for contrarian investing comes from looking at what are called loser stocks versus winner stocks. Sounds sophisticated, but it's very simplistic. I'm going to take you back to one of the earliest studies done on this, widely quoted study from the 1980s, where DuBont and Taylor, two behavioral economists, Richard Taylor won the Nobel Prize later for his work in behavioral economics, took US stocks and looked at the returns they'd made in the previous 3 years and classified them into winners and losers based upon how well or badly they did in the last 3 years. So the winner portfolio, the stocks that did the best over the last 3 years. The loser portfolio is the stocks that did the worst over the last 3 years. And then they tracked the returns on these portfolios for the next 36 months. You can take a look at the graph. It's not a high-tech graph. It's from the 1980s. But you can see the loser portfolio clearly outstrips the winner portfolio. And over a 36-month time period, you actually get an extra return of 30% if you invest in the loser portfolio versus the winner portfolio. That's pretty dramatic, right? Now, in the years since, people have chipped away at this result. And perhaps the most interesting counter to this study came in the 1990s. Again, an old paper, but a paper that's been reinforced, where Sheridan Titman and Jagadish looked at this. It did exactly what DuBont and Taylor did. But instead of just focusing on the long-term return, they looked at returns on a monthly basis. So same winner and loser portfolios. They tracked the difference between the winner and the loser portfolios. 1 month, 2 months. So when that number is positive and the number is climbing, it means the winner portfolios are doing better than the loser portfolios. Interesting results, right? For the first 12 months, the momentum effect wins out. Winner portfolios continue to win. After that, there's reversal, but even with the reversal built in, especially if you look at the 1965 to 89 time period, the winner portfolio remains winning. This tension between momentum and reversal is inherent in almost all of these studies that look at price patterns over time. So if you're thinking about buying loser stocks, consider this fair warning. You might have more losing ahead of you, and eventually you might start winning, and there's no guarantee, even in the long term, that your portfolio will emerge as a winner portfolio. So that's, bludgeon corporatism. And when you look at knee-jerk corporatism, if I had to sum up, buying something that's falling is like catching a falling knife. You could hurt yourself. You don't know whether you caught it at the right moment. There might be more to come. The second is when there's a real reason why something is being sold off, whether a company or the market. You're not getting a bargain. You might be getting the new pricing for the company, in which case there's going to be no bounce back effect. But as you can see, buy the dip, widely promulgated as advice when markets are falling. Now, I'm not a great believer in knee-jerk contrarianism, but I was just curious about what would emerge if I looked at U.S. equities and looked at the companies that have fallen the most. So here's what I did. I take all U.S. equities with a market cap greater than $1 billion. I was trying to prevent those small companies because in those winner-loser studies, one of the flaws with the initial study was they did not screen for low-price stocks or small-cap companies. And it turns out some of the biggest losers were very low-price stocks and small-cap companies. High transactions costs, low liquidity. So here I'm screening only for companies that have market cap greater than $1 billion on December 31st of 2024. Then I look at their market cap on March 28th and then on April 18th and look at the percentage change. So let's take an example. You take Vishay Intertechnology. It had a market cap of $2.2 billion on March 28th, down to $1.52 billion on April 18th, down 30.55%. And as you go down the list, you can see 30, 35, 40%. Now, you might notice that there are quite a few biotech companies and technology companies. You're saying, what's going on? That's a problem with bludgeon investing, is when you look for the biggest losers, you might get a disproportionate share of a sector that has lost, perhaps for good reason. So that's bludgeon contrarianism. Let's move on to the second strand of contrarianism, which is technical contrarianism. In technical contrarianism, you look for stocks and markets that have dropped significantly, but you add a requirement that you will buy only if the pricing pattern, there's some requirement of a charting or a technical indicator that has been met. In other words, using technical analysis to detect when to buy. I know there are people out there who view technical analysis as voodoo investing. I don't. I think that charting patterns and technical indicators give you signals of shifts in mood and momentum. I'm not good with them, but there are others who might be. And if you're trying to detect when the bottom is being reached, they might help you. So you can view technical contrarianism as buying stocks that are down, but only if you feel that the mood is shifting based on your indicators. As I said, I'm not a big technical analyst, so I could not tell you what the best indicator is. But talking to technical indicators, there's no consensus even among them as to what the right indicator is, and even with an indicator, whether it's a bullish or a bearish sign. So it's very difficult to check technical indicators because there is no consensus around. Technical indicators themselves broadly can be categorized into price indicators or volume indicators or combinations of the two. They can be very simple, relative strength, when you look at the percentage price change, or moving average prices, to complex ones that combine price and volume. Now, in recent decades, investors have added to the list. They've taken data from the volatility index of the VIX and other markets, option markets, and added it on as market timing devices. At the risk of generalizing, technical indicators try to detect the fear factor in the market and when it is the right time to get in. Now, what's the evidence in support of technical indicators as aids when you do contrarian investing? Well, there is some evidence, and I'll add some qualifiers. There are studies that have looked at the VIX as a predictor of what the S&P 500 will do in future periods. If you take a look at this graph, for instance, it looks at the returns you will earn in the S&P 500. The VIX is below 12, a really low VIX, which means that the market measure of fear is really low, between 12 and 20, which means the fear has risen, and above 20 when it's really high. If you look at when the market has a really low measure of fear, VIX below 12, you get this peaked distribution in the middle, an expected return that is low and not much variation around it. Between 12 and 20, the darker graph in the middle, a much wider distribution, a slightly higher expected return. VIX above 20, in other words, the fear factor is high, you get the highest expected return and much more uncertainty about the future. Kind of makes sense, but basically there is some market timing power. On individual stocks, it's interesting that some of the most effective evidence doesn't come from technical analysts, it's come from academics. One of my favorite papers is by Andrew Lowe, Wang, and Mamaski, where they look at different technical indicators and they bring in the power of computers to actually find patterns, much better than individuals. So think of this as the future, if you think of AI doing this. And they do discover that that by looking through the data, they can find patterns in prices that can be used to predict future prices. You think this is amazing as a technical analyst, but don't get too excited. Now, as they looked at the evidence on how much you could earn as excess returns, their conclusion is you can only earn marginal incremental returns, which is an academic code for you make a really small extra return. So if you're expecting to make 10% more, 8% more, dream on. And I have a feeling that technical contrarianism will become much easier with AI and computer power at your desk. I would love to give you a set of stocks that emerge with technical contrarianism, but two problems. One is I don't know much about technical indicators and I couldn't tell you which ones to use. And second, the data set that I use, Capital IQ, doesn't have a whole lot of technical indicators built in. But clearly, it's a second way in which you can approach contrarian investing. There's a third approach to contrarianism that I call constrained contrarianism. Think of this as the approach that somebody who comes from the old-time value investing school would adopt. Remember, the old-time value investing school, the objective is not just to buy a cheap stock, but a cheap stock that doesn't deserve to be cheap. In other words, a good company trading at a beaten down price. So in constrained contrarianism, in addition to screening for stocks that have dropped a lot, you also look for are the things that make them good companies: high profitability, strong moats, competitive advantages, low risk. What you're trying to do in constrained contrarianism is to avoid that nightmare for every value investor, which is the value traps. Stocks that look cheap, that you buy, that become cheaper over time, and you're hoping the screening prevents you from investing in those companies. Does it though? The evidence on whether screening helps you keep out of value traps comes largely from looking at the interplay between proxies for value, low price to book, low price earnings, and proxies for quality, high operating margins, high returns on capital, low risk, low volatility, low debt ratios. Proponents of quality screens argue that by doing this, you keep out the value traps and the returns you will earn will be higher because you've kept out the worst of the stocks. So if you adopt constrained corporatism, you're adding those screens on top of the money-losing stocks to find out which ones come out. Now, is there evidence that quality screening helps? Marginally. Now, it's not particularly persuasive, but it is there. This is from a study by research affiliates where they looked at returns, annual returns on U.S. stocks between 1990 and 2022, 32 years. They initially just screened based on pure value, low price to book, high to price to book. And this was a 32-year period where the low price to book effect disappeared. You can see, in fact, the evidence right there. The middle of the distribution earns higher returns and the lowest price to book or the highest price to book. And then they added a screen for quality, and they brought in both measures of operating efficiency and low risk. And what they discovered, when you screen for quality, the returns on the lowest price to book stocks increases, but the effect on the highest price to book stocks is non-existent or not there. In other words, screening for quality will help you if you're going after cheap stocks, low price to book stocks. That's the extrapolation you would make to contrarian investing, that there's the additional oomph you get by adding on quality factors can make your contrarian investing more effective. As I said, I'm skeptical, but I'm willing to give it a shot. So I returned again to my universe, 6,000 publicly traded stocks. I screen now for market capitalizations, greater than 100 million. Again, I wanted to remove the lowest market cap stocks because of liquidity and transaction cost reasons. And then I ran 3 screens. First I screened for stocks that have lost more than 20% of their market cap between March 28th and April 18th. That would put you in the bottom quintile of all US stocks, and then added 3 other screens. A PE ratio less than 15 on December 31st to 2024, which would put this, or PE ratio less than 15 based on the April 18th price, which would put you in the bottom quintile of US stocks in terms of PE ratios. A dividend yield that exceeded 1%, which is a paltry number by historical standards. But since 60% of US stocks don't pay dividends, that puts you in the top quintile in terms of dividend yields. And a net debt to EBITDA ratio of less than 2, again putting you in the bottom quintile. So I'm looking for stocks that are cheap, that have higher dividend yields than the normal US equity, which is pretty, as I said, pretty close to zero for most US equities, and low net debt. Okay. I don't know what to make of this list, but you're welcome to give it a closer look. But these were the 8 companies that came through with those screens. For instance, if you take Murphy Oil, it's down 25% between March 28th and April 18th. Trades at 7.5 times earnings. It's a dividend yield of 5.9% and not very much debt. Alcoa, same kind of phenomenon. Trades at a really low PE ratio. And if you're one of those old-time value investors who adds this layer of contrarianism, those might be the stocks that you go to. Now, there's a 4th approach to contrarianism that I call opportunistic contrarianism. Here, what you do is you go back to a list of companies you've had well before the market drop that you've always wanted to own, but you could not because they were priced too high. What does the price drop do? It brings some of these stocks down into underpriced territory, and you essentially buy them because they're now cheap. Now, to understand this process, I'm going to take you back to a post I did a long time ago about why good companies are not always good investments. And the way I presented it was to present a matrix where if you can tell me what you think about a company, And I could tell you what investors and markets think about a company. We can get a sense of whether the company is going to be a good investment, a great investment, or a bad investment. So let's say you have a company that you think is an awesome company, and the market thinks it's awesome as well. Hey, that's a neutral investment. If you think it's an awesome company, the market does think it's a very good company, that's actually a bad investment, an investment which is overvalued. So essentially, when you get an assessment of a company that is higher than the market, you got an undervalued company. The reverse, you got an overvalued company. So what you're looking for in investment is a mismatch. And what a price drop can do is create more of those mismatches. So with that in mind, let me take you back to August 2024, when I valued the Mag 7 and I found every one of them to be overvalued. Tesla at that time was the least overvalued. Meta was slightly overvalued, but and this was with very robust and optimistic assumptions about the future. Every one of them is overvalued. And I remember getting emails from people saying, I wish I'd bought the Mag 7. I'll never be able to because they're all too expensive. They've always been too expensive. And my counter was, not true. Because I owned all 7 of these stocks in August of 2024. I didn't buy them in August of 2024. I'd bought them at different points in time. Every one of these stocks, I argued, had been cheap at least once, probably 2 or 3 times in the previous decade. Microsoft, I bought in 2013, right after, or 2014, as Satya Nadella came in. People had given up on the stock. Apple in 2017, Nvidia in 2018. I mean, I obviously didn't get the timing right on all of them, and I might have sold too soon in earlier iterations. But that's neither here nor there. These stocks are all overvalued in August in 2024, but they might be undervalued now. So here's the process of opportunistic contrarianism. You start the process well before there's a market crisis. You look for great companies. And in this graph, I've kind of listed out what I'm looking for in a great company. A great company is a unique combination. To understand what that combination is, I think about what I call my valuation triangle. One side of the triangle is growth, the second is profit margin, the third is reinvestment. Here's what a great company looks like. It's got great revenue growth, high profit margins, and low reinvestment. Uncommon, but that's a great company. A terrible company reverses everything. It's got low revenue growth, low margins, high reinvestment. Most companies, there are trade-offs. You have high growth with low margins, high margins but low growth, high reinvestment, but lower cash flows because of that reinvestment. So let's say you find some great companies, and there are a few out there. Look at the price, and the price is too high because everybody else thinks the same way you do. Put it on a list. Don't try to tweak the numbers, though you might be tempted to make those companies into investments because you want them so much. Go back to the rest of your life. During a market crisis, especially when investors are dumping everything, good and bad, they're not discriminating. Wait for the correction to happen. But don't compare the price post-correction to your original valuation of a company. Why? Because something caused the crisis, right? It could be in 2008 was a banking collapse, 2020 it was COVID, 2025 it's tariffs. You got to revalue the company with that crisis built in. And if the price is lower than that value, hey, you got your buy now. That's opportunistic. And I can't list out, the things you have to do, but that's the companies that are on my list. But you got to come up with that list of your great companies and wait for your chance. Now, having said all of this, the argument for contrarian investing is intellectually strong. Most people look at it and say, of course I should be a contrarian. Now, before you make that jump, though, remember the biggest challenge to being a contrarian investor is not that we don't know what to do, but the psychological test of whether you can pull it off. Because there are 3 aspects to being a contrarian that are tough to pull off. The first is a mindset. When you're a contrarian, remember you're going against the market. You're going against what most other people are telling you to do. And if you're easily swayed by peer pressure, that's going to be really tough for you. So you know who is better suited to be a contrarian? That person who marched to their own drummer when they were kids. You're okay being on your own. Do you have that mindset? Be honest. If you do, better suited for the contrarian lifestyle and investing. Second is in terms of time horizon. Not all contrarian investing strategies need a long time horizon. Sometimes you can pay off in 2 weeks. That said, though, you have to be willing to wait long periods sometimes. So not having a long time horizon can be an impediment. And third, you got to have the stomach to pull this off. Remember the loser stock study where for the first 12 months, you had to live with losers continuing to lose before they finally turned around? You need a strong stomach. Even if you do everything right on contrarian investing and buy those beaten down stocks and you expect them to go up, don't expect the recovery to happen the day after you buy the stock or the week or even the month after. In the first few weeks, you're probably going to get more pain and you need a strong stomach to get through it. I've never believed in hiding behind abstraction. So I'm going to put out what I think about my standing on contrarian investing. I do have the luxury of a long time horizon. It's a luxury because it's not something I earned. It's something that's built up over time. I have the luck of a strong stomach, both for food and for market surprises. I'm not easily swayed by peer pressure, but I'd be lying if I said I did not feel any peer pressure at all. In other words, I think I can buy stocks in the midst of selling, but I'm not sure I can. So here's what I've increasingly turned to doing, and it stood me in good stead during this crisis. I make that list of companies, and I made this list a while back, before April 28th, of companies I wanted to invest in. I'll give you 3 of the companies on that list: BYD, Mercado Libre. BYD is the Chinese electric car company. Mercado Libre, which is the Latin American online retail/fintech firm, and Palantir, a company that mystifies me, but I think a company that I believe is closest to delivering on the promise of premium AI products and services. I've always liked them, but they've always looked overpriced to me. So I put them on my list. I put limit buys, good till cancel, which means the limit buy stays on till I remove it on all 3. On April 7th, BYD briefly fell below $80, which was my limit buy, and my limit buy kicked in. And to be quite honest, if I'd had to put that buy in, given how terrible the market looked on April 7th, I'd probably have put it off and say, let me wait till tomorrow. Things don't look that good now. The advantage of a limit buy is I didn't even have to make the decision. It got made for me. Palantir and Mercado Libre got within 10% of my limit buy. It never quite got low enough. Palantir didn't even get close to my limit buy. So ways to go. But the crisis is young, and who knows what the next few weeks will deliver. But remember that even if I don't get these companies at the limit buys, they stay on my list, and I'll keep coming back to them with new limit buys based on updated valuations. So if you are tempted to buy the dip, I hope you found this session useful, and I thank you very much for listening.